So when you make an investment, you don't want to make loss. So that is the unwanted outcome. And the possibility of having that unwanted or negative result or negative outcome or negative return is what we call the risk. So if you go to the higher side and you earn much more than what you expected, you're very happy, but you don't want to go to the negative side. Okay, so if there is a possibility of earning less than, what you expect, or especially negative return, then you are taking a big risk. Uh, uh, and it depends on how big the risk is and whether you can bear that risk or not. Okay, so and the relationship is together. If you increase risk, you will have more chances of earning higher returns, but the other vice versa is also um, quite expected. Now, this graph in particular will explain what we mean by that risk. So here we have got two different assets, two different firms, firm Y and firm X. And we have, for example, we have invested in these two firms. We have bought their shares. When you calculate the expected return of the two assets, and what we mean by that expected return is basically the average return over a period of time. So sometimes it goes up and other times it goes down. But that average over a period of time is what we call the expected return. Okay, for both of these assets, the expected return is 15%. Okay, and that line goes up, for the two. So it is the same middle point for the two assets, 15% for both of the assets. Now, which assets are you going to invest in if they have the same expected return? Of course, you will go for the one that has smaller risk. Now, can somebody tell me which of these two assets is riskier in this case? X or Y?
I think Y is riskier, Professor.
Exactly. And why do you think so, Samir?
Because of the spread, it's spread much further. The standard deviation is bigger.
Exactly. Exactly. That's fantastic. So let me explain this a little bit. Samir probably understands because he talks about standard deviation, so he has gone through that. But let me explain this without going to the standard deviation yet. So this firm X, if you look at the graph, the return can spread for example, like minus 10, 15, and it can go up to about 90. So that is the spread. That is the range that the return can go to. Okay. Even then, the expected return, if you find the average over a period of time, it is still 15%, but it goes to those two limits. If you look at firm Y, it can go much higher than the firm X. It can go even like, if you see like 115 or 120% is compared to firm X, which can only go to like 90%, for example. But on the other hand, it can also go way down to the negative side, even minus 80 or minus 70 or 80%. So in this case, the risk is way higher and the expected return for the two is the same. Now, in that case, if two assets have the same expected return, but one is more riskier than the other, of course, you would go for the one that is having less risk for that given expected return. But normally, what happens is that if the risk is higher, the expected return could also be higher in that case. So we will look into those examples. But this is a good example to understand what we mean by that risk, and it is very clear that firm Y is riskier, but because its return can go way down to the negative side, even though it goes up to the positive side as well. Okay. Now, we will be going through an example, a hypothetical investment scenario, and we'll be calculating the expected returns and risks of these different assets and also the average for the whole portfolio. Now, and this is coming from your book, so you can have a more in-depth reading on this in your book. But here's the scenario. We expect the economy to be either in recession or below average, average, above average, or boom. These are the different scenarios for the economy. And in the second column, we have the probability of that scenario. Like we can expect a recession, but the probability of recession is only 10%. 0.1 means 10%. Below average is 20%, average is 40%. So that means like the high probability for the economy, and the highest is average. And above average again is 20%, and boom is 10%. So these are the different probabilities. And these probabilities basically come from lots of statistical analysis of previous data and what is happening in the economy and stuff like that. Remember, this is not the current data. This is just a hypothetical example. Okay. And it depends on the world scenarios and the wars going on and the interest rates and inflation and all those things are taken into consideration to calculate the probabilities of these different economic situations. And then we have these different types of assets. So we have got T-bills and high-tech industry, and we have some collections in U.S. rubber and market portfolio. So the T-bills, these are the treasury bills. And if you can recall from one of our previous chapters that we had a detailed discussion on the T-bills and T-notes and T-bonds, these are the government, T-bills are the government issued bonds. And if you can recall, these are what we call the risk-free assets. So they don't have any risk. And that is why you have 3% in all the economic situations. It doesn't matter whether it's recession, below average, or boom, you always get the 3%. That there is no risk involved. For the high-tech industry, if there's a recession, you have the possibility of losing 29 or about 30% of your money. But if the economy is in boom, you can earn 42% as compared to the 3% on the T-bills. So anyone, like, I mean, there will be two different persons, same amount of money they can invest. One will be investing in T-bills, another person is investing in high-tech and tech industry. Recently, I mean, like, one person is more risk averse and tries to be on the safe side and foregoing, like, those higher returns, but the other person is taking risk and there's a possibility of earning a lot of money as well. For the collections, we have these different rates as well, and US rubber, these different data points that we've got in the market portfolio. So this is also a hypothetical situation where the example, like, we have combined the whole market portfolio, and that market portfolio actually would mean like the S&P 500. So you take the return on the S&P 500. That is what we call the market portfolio. So what we mean by that is that if there's a recession, S&P 500 would be losing you 19.5%. If it's a good economy, boom, then you'll be earning 35.5% on the S&P 500. But if you want to invest in these individual sectors, then these will be your returns. Okay, now what we do then is to calculate the expected return of each of these assets. So these are the different economics situations, probabilities, and these are the given returns in those particular situations. But now we were talking about the future, so we don't know, like, exactly what's going to happen, but we can calculate the expected return for each of them. What do you think would be the expected return on the T-bills? Anyone?
3%.
3%, because that's always the same. So that's what we expect. It is the same. It doesn't change. For the high-tech industry, we have different numbers. But as I said, this is going to be the average return. But we can simply calculate the average of these numbers to find the expected return if there is no condition of the different probability of, for different economic situations. If that is the case, then what we need to do is to first multiply the given return with the probability and then the other return, and then find the expected return after that. So whenever it talks about the probability of different economic situations and you have the given returns, simply finding a simple average of these numbers would not work. You will have to find it slightly differently. And here's the formula. What you need to do is you will multiply the probability of each economic situation with the return of that asset in that situation. Okay, so like for example, here for the high-tech industry, the probability of recession is 10%, and the return in that case would be minus 29.5%. So we multiply these two numbers, okay? 10% multiplied by 29.5%. Okay, and then when we have all of these like this, 0.2% multiplied, 0.2 with multiplied with 9.5%, and then this multiplied with that. When all that multiplication is done, we simply sum these numbers up, and that will be the expected return. So that is how we calculate the expected return. And if you are somehow familiar with statistics or a little bit with finance, often we term this, denote this expected return as the R cap, like here. And this summation, that what that means is that we first find the multiplications of these numbers and then find the sum. So here's what we have done, like, 0.1 multiplied with minus 29.5% plus the other multiplication plus the other in whatever numbers we have. And so when we have the sum, that is coming out to be 9.9%. Okay, now if you're using, then you will be doing that this way, like as you can see here. But if you want to use your Excel, for example, then it will be slightly different. So how do we do that? So let's go to the high tech industry, because this is what we talked about. So here it is. I just simply copied that data and cleaned it up for you a little bit. So these are the probabilities of the different economic situations, and these are the given returns in those situations. So what we do, we first multiply, okay, we multiply the probability, okay, of the economic situation with the return that we can expect in that situation. So that's simply the multiplication of the two. Okay, and then you apply this to everything, and that's what you get. And the expected return would be the sum of these. Okay, equals to sum of these probability adjusted returns. So we get 9.9%. And that means, like, if you invest only in the high tech industry, you can expect, like, that return if you have invested over a long period of time. And what we mean by that is sometimes your return would go to negative, sometimes it would go very high, other times it will be like in the middle. But if you calculate that over a large period of time, a long period of time, then your expected return would be 9.9%. Okay, and we can do that for the others as well. So like here, for the T-bills, what I did is, like, I simply copied the same table. The probabilities are the same, but I go to the data table and I copy the values for the T-bills. I simply copy those values, and then I paste it for the in the T-bills table right here, and that's it. I have done the same calculations, same multiplication. So probably we don't need to redo, but let me just redo this one more time for you so that you understand it. So again, we multiply the probability with the given return, and we do that for all of them. And then we find the sum equal to sum of these probability adjusted returns, and we get 3%. And you can see, like, the given returns are also 3%, and the expected return is also 3%. So because that is a risk-free asset, you will always get what you expect. Is it clear? Any question on this? All right, so
No
seems like, okay, seems all good. If there's any question, clarification needed, please stop me in the middle. So that's how you're going to calculate the expected return. And the type of question you can expect in the exam, like for example, a short question would be um, something like this. You are given the probability of the different situations in the return of the asset, for example, this one and that situation. You may probably get this data in a tabular form or this numbers given within the problems. You have to take that out. So you will simply be doing this process, like finding that probability adjusted returns and then finding the sum. That would be your calculation. So you won't have to go through the whole story. Like in this whole chapter, we're going through, like we're covering the whole story and doing lots of calculations. But the questions would be like that you can expect would be just part of that whole story. Okay. Then if we do that whole process for the whole industry, so we just did the calculations for the high tech, and our answer was 9.9%. We also did that for the T-bills, and that was 3%. But if we do the same process for the US rubber and for the market portfolio, then we have the next asset, then that is 8%. And for the collections, the expected return is 1.2%. Okay. Now, which one has the highest expected return? Of course, the high tech industry has the highest expected return. Okay, so are we gonna go for that one? Or if we have to invest, are we going to invest in the high tech industry because the expected return is the highest? Well, probably, yeah, probably not, because we haven't looked at the risk that we are taking. Okay, so what we will have to do is to compare the return with the risk that we are taking. So the next step here would be to calculate the risk of all of these different assets. And probably, like, the market's expected return is 8%, which is lower than the high tech industry, like about 2% less than the high tech industry. But maybe when we look at the calculations later on, maybe the risk that we take for the 8% is much less than the risk that we take for the 9.9%. So in that case, we'll have to decide whether, which is a wise decision. Even though we're getting an expected return of 8%, but the risk that we take for that 8% is much less than the high tech industry. And then a wise decision would be to go for that one because we are getting comparatively higher return for the given risk that we're taking. So the next step is to calculate the risk of all of these assets. Any question? Okay, so risk is calculated in this way. We call the risk as standard deviation. That is what Samir mentioned the term, standard deviation. It is denoted by sigma, okay? And the formula is variance under root. But what is variance? Variance is basically sigma square. But we need to find that sigma square first. The steps involved are, what we need to do is this Ri is basically the given return of those assets. So going back, these are, for example, like for the high tech industry, these are the Ris, the given returns in those situations. Okay. And this R cap, that is the expected return that we just calculated. So we will subtract the expected return from the given return in all of those situations. So what that would mean is that we will subtract this 9.9% from minus 29.5. Then we will also subtract it from this number. We will subtract it from that one, from that one. Okay. And then when we have that subtraction, we square it and then multiply it with the probability of that situation. So a little bit, tricky to understand for those who are completely new to statistics, but not a big deal if you understand the process. There's no like complicated math involved. It's just simply understanding the steps. And when we multiply it with the probability, then we will find the sum of all of those numbers. So there will be like several numbers that we find the sum for. And when we have the sum, we take the square root of that sum, and that will be the standard deviation. Standard deviation is basically the risk. The higher the standard deviation, the riskier that product or investment is. Okay, now how do we do that? Here's the process. So let's do it step by step. Okay, so let's look at the formula. What do we have in the formula? The first thing that we need to find is the RI minus the expected return, the given return minus the expected return. So let's do that. I have created that column. RI is the given return, and the ER is the expected return. So let me do that. Equals to, what is the given return of the high-tech industry in this situation? That is 29.5%. And minus the expected return. Expected return is 9.9%. I did that, so that is one thing that I just did. Now, if I have to drag this formula down, of course, I want this expected return to remain the same for all of them. So let me do a little bit of changes in the formula. Let me make this fixed with the dollar signs. With the F4 button. And when we drag it down, you can see that the given returns change for each calculation, but the expected return is the same. So it is subtracting the expected return from all the given returns. Okay, so that is one part of the formula that we just completed. We calculated the R, the given return. That we subtracted the expected returns from the given returns for all the scenarios. What is the next step to do? Is to square this. You see that? The next step is to square that. So I have done that. I created this next column for that. I square this difference that I just calculated. So that is equal to the that number is squared, raised to the power 2. All right. And so I drag this down. So that is also done. What is the next step in the formula? Is to, when we have this square number, we multiply it with the probability. So we go to the next step. We take the probability, which is in this case 10%, and we multiply it with this number, that squared difference. Okay, square difference from the mean. And that is done. I simply drag it down, and all of those numbers are squared. Okay, so what do we have in the formula now? I calculated this whole thing, right? That square difference multiplied by the probability. The next step is to sum this up, find the sum of all of them. So the sum would be, and of course, for the standard deviation, I will have to find the square root of that sum as well. So let me combine those two steps into one. I can do SQRT, which is the square root, and I'm taking the square root of the sum of these numbers. Okay. Close the parenthesis and then close it again because I have started two, and that is what it does. So I did two steps, combined two steps. Now you can see that the standard deviation is 20%. Okay, so we got that standard deviation. And we can do that for the other industries, for the other assets as well. Like for example, for the collections, let's do that whole process again for this one, and then you will be able to understand the rest. So the RI, which is the given return minus the expected return. So given return is 24.5 in this case, minus the expected return, which is 1.15%. And let me put the dollar sign here so that when I drag it down, the expected return reference does not change. And the next step is to square this number. So this number raised to the power 2, I squared it. Okay, drag it down and drag it down, and you have those numbers. And then multiply the squared number with the probability. So 10% probability, and multiplied with this squared variation, and we drag it down. So we have all those numbers. And then the final step is to calculate the standard deviation. So standard deviation is the square root of the sum of these numbers. So SQRT, parenthesis start, and then sum of these numbers. Okay. And I got the standard deviation of 11.23%. So that is the risk. And you can clearly see that the risk of this asset, which is the collections, is 11%, is compared to the risk of the high tech, which is 20%. So high tech is more risky, but of course you can see it also gives you a very high expected return. So you see that trade-off. And if you repeat that process for the other assets, you can see those numbers right here. And I'm gonna. Any question? Do you want me to do the rest of this for you, or should that be good enough?
Professor, this spreadsheet will be available on the Canvas as well.
Yes, I will send it, but it's still incomplete. I'm still working on it. So once I complete it, I will send it over to you.
Okay. Thank you.
You're welcome. And we need another class on this too, so it will be done. But as soon as I complete it, I will share this and we can discuss the remaining stuff in the next class. Any other question? All right. Okay, so the same thing for the market portfolio. Now let's do this. Let's combine this. Like, what does it mean? Like, we have a 15% standard deviation and 8% risk. Let's combine all of these numbers into one table so that we can make sense of those. So this is how I do it. I just calculated the expected return for the T-bills. So let me make this equal to, and I go to the T-bills sheet and I bring that expected return. And similarly, I take its standard deviation as well. So equals to, I go to the T-bills and I take its standard deviation. How that is clear. Same goes for the next one, high-tech industry. So expected return and standard deviation for the high tech, which I just did. Okay. And for the collections, I go to the collections tab, expected return, and its standard deviation equals to collections tab, and I pick up the standard deviation. US rubber, I go to the rubber and I take its expected return, and then I take its uh, standard deviation. Okay. And then the market portfolio, I go to that tab. Okay. And it's standard deviation. So I got these numbers, and now it's easy to compare them. So for the T-bills, there's 3% return, and that is a small return, but there's no risk involved. So that is one thing. High-tech industry, it has the highest return, but it also has the highest standard deviation, which means the highest risk that we take. Okay. Collections, there is 11.2% risk. So taking these T-bills out, like, that is risk-free. Amongst these other assets, if you can see, the collections has the smallest standard deviation, the smallest risk. So what do you think? Should we go for this one apart from the T-bills because it has the smallest risk? Well, we need to look at that. It has the smallest risk, but if you look at the expected return, that's just nothing. 1.2% is nothing. So it doesn't mean that we should. If we have to go for the U.S. For the collections, it is better to go for the T-bills, where we get even a higher return, 3%, with no risk taken. But then why would people invest in collections? That is basically because it's some people's just hobby, and they invest in it. So that's another story. They take the risk just for fulfilling their hobbies. But financially, it's not a wise investment. And the U.S. rubber, so I didn't look at that. The U.S. rubber has the highest risk, and the market portfolio has 15. No, not high tech. High tech is the highest risk, and second is the U.S. rubber, and third is the market portfolio, and that gives us 8% return. But still, I mean, making this comparison is still very hard to do. So if you can recall from our ratio analysis, when we calculate the ratio, it is easy to compare two different companies, like a liquidity ratio or, net profit margin. So when we convert those into like those types of percentages or times, it becomes easy to make sense of the whole story. And that is basically what we call the that percentage. That basically is a ratio, and we call that ratio as uh, coefficient of variation, denoted by CV. And the formula is we take the standard deviation, which is sigma, and we divide it by the expected return. So now it is a ratio. And what that would mean, when we divide the standard deviation, which is the risk, by its return, it basically make the two comparable. What is the amount of risk that we take for every percent of the return of the asset? Okay, so we will calculate that coefficient of variation, CV. So what do we do here? I have both the numbers. I take the standard deviation and divide it by the expected return of that asset. And by the way, it changed it for me. So let me, because that R within the parenthesis is short for the registered symbol. So sometimes it does that. And I can simply drag this down. Okay. And now it makes a lot more sense. So let's look at the high tech industry, for example, right here. The coefficient of variation is 2. And what that means is that the risk is the standard deviation is twice the return, twice the expected return. Okay? The standard deviation is, or the risk is twice the expected return. If you look at, apart from the T-bills, which are zero risk, so that is a different story. But if you look at the collections, for example, right here, the risk, even though the collections risk is the smallest amongst all of these assets, but when you convert that into the ratio for coefficient of variation, it is 9.8, which is the highest now. And what that means is the risk is 9.8 times more than the expected return. So that means we are taking a huge risk as compared to the return that we would be expecting. And for the US rubber, that is 2.6%, and the market portfolio, that is 1.9%. Now, which asset, now based on this discussion, which asset would you invest in?
Portfolio.
The market portfolio, because the risk compared to the return is the smallest amongst all of these. So it's a wise idea to invest in the market portfolio. And that is one of the reasons that these investment advisors and everyone out there in the market would be talking about your portfolio. You should do this with your portfolio and that. And they talk about portfolio diversification. And what we mean by that is that you bring in different types of assets into your portfolio so that if one asset goes down, you have others that are going up, and you are not losing money at the same time. If you invest in just one single asset and it's a risky asset, if you're lucky and it goes up to by 100% or 200%, you become rich in a few days. But what if it goes down and it goes to zero? You lose a lot of your whole investment, and you would not be able to bear that. So it's a wise idea to build your portfolio in such a way that your coefficient of variation is the smallest. And what that does is that it gives you the highest return for the given risk that you're taking. So that means the risk is comparatively smaller is compared to the other assets and the other assets return. All good here? Any question? Can I give you a smaller assignment in group so that I'm sure that you are here with me and you were listening and you understand everything. Anyone?
I'm listening.
Say hi to me, everyone. I want to
Well, hello,
introduce.
Professor. Yeah, no questions. Everything seems clear so far.
Hello, Professor.
Okay.
Hello, Professor.
All right, fantastic, fantastic. So, do you want to do a small exercise or good to go?
Good to
Okay.
go. Good to continue.
Okay.
Good to go, Professor. We're good.
All right. Okay, so sounds good. So that's what we have right here. And by the way, here in each of these separate tables, I have also calculated the coefficient of variance. So again, the same thing. We take the standard deviation and divide it by the expected return. So that's what I get. Okay. For the high tech, that would be equals to the standard deviation divided by its expected return. The same thing that we got in the CV tab. And also this one equals to standard deviation divided by the expected return. And then the US server that's already done over there, market portfolio already done. So equals to, if you want to redo it, standard deviation divided by the expected return. But when these numbers are in these separate sheets, you cannot make a sense of them and it's hard to compare them. But when you bring all of those to the same table, it's very easy to make a comparison and see which one is the best. All right. Okay. Now, one of the things that you might be wondering about is that, like, there are lots of calculations involved in these different tables. There are ways to do it a lot more simpler than that, but just for making you understand and just going into the details and understanding the basics of the statistics as well here, I created those tables for you. But in other words, like, just to explain it to you, like for the expected returns, I can do it very easily here. Let me expected return of these assets. So what I can do, there's a function in Excel which is called sum product. You can use that if you would like to do it sum product. Sum product. And what that does is that basically for the expected return, for example, for the high-tech industry, what we need to do, we need to multiply the probability with all of these returns and then find the sum. So this function will do those all of those steps in just one function. What it will do, it will multiply each of these probability with the given return and then sum the answers. So let me do that. It is asking for arrays. So array means that series of data, okay? So I select these probabilities in comma, the next array that I want to multiply. So I do, like, for example, for the T-bills, and that is what we want. I want to multiply just these two columns, and I close the parentheses, and I got a 3% expected return. It's the same that we got over here. So that makes things much easier. But in that case, then you would not be able to, like, thoroughly understand the steps that are involved in why we do that, because we have to build the formula. Okay, now I can drag it to the right, but for that purpose, I need to because this probability has to be multiplied with all of these columns. So let me make that probability column that with the dollar signs. I can make this fixed and okay, this one too. All right. Let me see if that works. So just, oh yeah, it works. You see, it is now multiplying those probabilities with the next column for the high tech industry, and then you drag it to the right, and you've got all the expected returns just in one row. Okay, in previously, like we did this whole thing, this whole stuff in order to calculate the expected return. So if you are a little good in Excel and you would like to do it that way, however, the standard deviation would be a little more complicated to do so. It's better to use this method.